Welcome to this video on financial economics foundations. So here we are looking at quite a broad array of different topics, and it's really a series of tools that we're going to be using all the way through the CAIA curriculum. These could be topics that are addressed in a traditional finance textbook. They're not specifically addressed at alternatives, it's just we're going to be using these tools. So market efficiency, we're going to talk about that. We're going to talk about fixed income markets, in other words bonds, and the returns that they offer and the risks that we face when we invest in them. So we're going to talk about duration, modified or otherwise there. We're going to talk about a modelling technique called binomial trees, where we assume the world is a binomial world where things can go up or down. And we're going to get comfortable with the basics of credit risk, the risk that we don't get paid back. CAPM we're going to meet formally, and hypothesis testing we're going to meet formally, even though we've briefly touched on applications of these already. So once again, the need to know concepts can act as a list to tick off that you've got your foundations in place here. Let's start with market efficiency. A market is an efficient market if prices in that market reflect available information. A market is inefficient if you can find out some information that is not reflected in prices. And it's that sort of inefficiency that active managers take advantage of. So active managers want markets to be informationally inefficient. If you're an active manager, you take advantages of inefficiencies through your hard work and your access to information and your due diligence and your insight. You take advantage of these inefficiencies in markets when they exist. If markets are efficient, an active manager is not going to be very happy with that, because they're not going to be able to outperform. They're not going to be able to find out any information that isn't already priced in. All right. Now, there's different levels of information, isn't there? There's information relating to just charts, market data. So where prices have been, what volumes have been at different levels, and any indicator thereof derived, like moving averages, volatility bands, oscillators as they're called, lots of different indicators that can be calculated. You know, these are freely available on charting packages on the internet. You can call up charts and see lots of very technically minded indicators, indicators that are very technical. That sort of information, if you believe markets are weak form efficient, you believe that that's already priced in. These charts and volumes and indicators derived thereof, that information is already priced into that price. So you can't use charts and market data to outperform. That's a weak level of informational efficiency, because market data is a very small part of the information about a particular investment. Semi-strong efficiency is the idea that all public information is priced in to the price already. Market is sufficient enough to price that in. That does mean, by the way, that if a market is semi-strong efficient, then it is also weak form efficient, right? Because market data is a subset of all public data. All right. Strong form markets don't just price in all public information, that's market and other more fundamental information about securities and investments, but they price in private information as well. Now, you might raise your eyebrow at that and say, really? I'm not saying that they do, I'm just offering it out as a definition. What you'll find is, because insider dealing is illegal in vast swathes of financial markets out there across the world, that is a regulatory and statutory admission that it's not fair, and it knocks market trust if people that have private information abuse it and use it to profit personally. So it does suggest the fact that insider dealing is illegal. It does suggest that you can outperform from inside private information, and that means that markets are not strong form efficient. So really, it's the reason why it's called an efficient market hypothesis when we discuss this area is because it's a hypothesis to discuss. Nobody ever can really prove whether a market is 100% efficient all the time or not. Efficiency is really more of a dynamic thing. Markets can be more efficient than it's a relative thing, and it's dynamic over time. One market can be more efficient than another, and these things can change over time. Factors that drive